He's at Nuvama Asset Management. He's joining us now. Ajay, good to have you with us here. Thank you very much for your time. At the margin, I mean, actually, there is an underlying sense of unease with the big rally that we've had. Everyone, of course, wants to stay long. But when you talk to many, you get that sense that, you're along for the ride. But at the same time, there is a sense that maybe, a pause, some consolidation perhaps would do more good. Do you think we're at that point now?
Yeah, hi Prashant, and thanks for having me on the show. I also, to a very large extent, agree to what you're saying. I think we are due for some sort of consolidation. The rally has been, broad-based across large cap, mid cap, and most importantly, if you look at it, there are two big trends which I feel that if the transition takes place, then there can be some sort of consolidation or pullback. So one is globally, if you see that we are the third best performing market post Japan and Nasdaq, so which are both the developed world markets. And most importantly, within emerging markets, if you look at it, now we are looking extremely expensive. So if money has to move to other emerging markets, there can be some sort of shift from India. And then if you look at, local markets, meaning our markets, Indian markets over here, if you look at the high quality are looking now, reasonably priced, I would say, in terms of the time correction which they have gone through, and also if the earnings continue to be positive, meaning in terms of strong growth, then the large mid cap kind of names, the kind of rally which they have seen over last maybe I would say 3 to 6 months, they are looking a little more expensive versus the quality large cap names. So I think that if the trend really shifts on both these fronts, there can be some sort of pullback in the near term.
Ajay, hi, good afternoon. Just give us a sense on where we stand at the end of the quarterly report card, because I was going through the report that you folks had put out just a couple of days back, where one of the trends that was highlighted was that the EBITDA line, I mean, the growth at the EBITDA line now seems to be converging with the kind of growth that we were getting at the top line. Basically, whether we'll keep getting as much a margin kicker in earnings as we were getting in the first half of the year. And I mean, the note here says that this perhaps could pose some sort of a risk to the 15% growth expectation for next year. Just expand on earnings and where we stand, especially for the broader market, not so much the Nifty 50 perhaps, but what you've seen in terms of the deliverables at the end of Q3.
Yeah, sure. So, largely if you look at the way earnings have panned out, and I'll talk about, Nifty earnings as well as the broader market, it has been, last 3-4 quarters, we haven't seen at the aggregate level any sort of downgrade at the aggregate level. So some of the other sector has contributed. And if you look at, this quarter also, you'll see significant upgrades, first of all, coming from the oil and gas energy space. Then it was autos, cement, and to some extent, even metals. So there has been some sort of, disappointment on the banking side, but all the other sectors actually contributed quite a lot. Something like, Tata Motors on the auto side, within metals, couple of names. And as we all know, the oil marketing companies reported fantastic numbers. So in a way, if you look at it, last 3-4 quarters, some of the other sector has contributed in a big way, and therefore we haven't seen any kind of downgrades at the aggregate level. Now coming back to, the broader market also, you will see that, the discretionary side of the space or the pockets hasn't really fired, and that has been a big disappointment over last 2-3 quarters. But on the other hand, the whole capex and the investment sectors, investment-led sectors, they have reported fantastic numbers, both in terms of top-line growth as well as margins. So which we strongly believe that, it is not sustainable over next 3-4 quarters. And therefore, considering, what we spoke earlier, I feel that, markets will look for a major upgrade from here on to rally from the current levels. And that, I think, will happen only after a couple of quarters when we see the whole consumption side of the basket picking up. So margins are at elevated levels right now because of the lower commodity prices. So if you look at, most of the base metal prices over last 1 year, they have been down close to 10 to 15%. So my sense is that, even if that normalizes, the margins have peaked out to some extent on the capex side of the businesses. So therefore, for the next leg of an upgrade, we need to see the whole consumption sector lead it, and then we can see that particular pocket performing well.
Okay, all right, Ajay, just hold on to that thought. The 22,000 mark is getting breached as we speak. the big boys in there actually are seeing quite a bit of profit taking. Coal India is under some pressure. The stock is down close to 3%. JSW Steel, put up the intraday chart out there. That stock has done a quick U-turn of sorts. So intraday chart of JSW Steel comes up, and ONGC is another name that has seen a bit of a dip. But Ajay, there are times of volatility, times of correction where you get to buy those stocks that you are looking forward to. I think a couple of months ago we spoke about Glenmark Pharma, if I'm not mistaken, and that was one stock that you liked. Give us a couple of names. If the market goes through a phase of consolidation, maybe the headline index pulls back 5% odd, what would the stocks you be looking to buy, if you could name a few?
So I think one space which is still looking attractive both in terms of valuation and growth is definitely the whole banking space. They have underperformed quite a lot, and rightly so, because of the concerns on the whole NIM trajectory, on the concerns of overall, the liquidity factor, what we are seeing in the system. I think going into election and post that, once we see system liquidity easing a bit, I think that, the whole concerns on the loan deposit ratio and therefore NIMs will ease off. And then if you put the numbers and look at the valuation for most of these banks, they are trading, I think, below mean valuations. So my sense is that, in any sort of correction, one can look at banks, because eventually, if the economy has to grow at around 12% nominal GDP, I think, the system credit growth will continue to be, pretty strong. And eventually all these banks will end up doing pretty well. So my sense is that, most of the other sectors, not all of them, are to some extent, fully priced in. If you look at, something like a pharma or an IT, to a large extent, the valuations are very much there. But banking is still one space where, the valuations are looking pretty reasonable. And, it has underperformed quite a lot, I think, over the last 1 or 2 years.
So you're comfortable with banks. Many of the high valuation sectors and stocks can continue to remain expensive and trade at premium valuations on account of high earnings growth and confidence that the earnings growth will sustain. Where is it that you're uncomfortable right now and you will not hold it or recommend holding it in your portfolio, where the valuation is not justified?
Yeah, so Rima, actually, if you look at it, the whole capital goods sector, if you look at it, the way government was spending money over last 3-4 years, and even if you look at the budgeted numbers, the CAGR was somewhere in excess of 30% over last 3 years. And although it will continue to remain strong going forward, but that whole number, the growth factor is what matters at the end of the day in terms of the order inflow. That is coming off, that is expected to come off a bit from 30% to, I would say, closer to 14-15%. And then if you do the valuation for all the large cap or even the mid cap companies, these companies are now trading somewhere close to, I would say, anywhere between 50 to 60 times PE. So I think that, some sort of adjustment either in terms of price or, time is needed for that particular space. And therefore, I think that, we are not buyers at current levels into that space.
Ajay, we were just having this debate with our previous guest on oil marketing companies. I'm just taking that as an example because that was the last leg of the PSU rally, right? We've had railways, we had defense, and then you had the market latching onto OMCs. Do you think this is just an extension of the PSU frenzy, or is there real merit in continuing to expect elevated refining margins and elevated marketing margins for these OMC names?
So, Subi, I think that, I was on your show a couple of months back, and we were extremely positive, and we were fortunately pretty early in identifying that trend. Even at that point of time, as we had discussed, most of these names were available at below book valuations. And most importantly, the street estimates were significantly lower versus what these companies could have reported. So if you do the numbers, most of the, if you just take an example of, IOC, now they'll end up doing somewhere close to 50,000 crores of EBITDA ballpark, which earlier, market was expecting it to be somewhere around 35,000 crores. So there has been almost 50% upgrade in terms of the estimates. And then actually, if you look at it, they were trading below book. Now they are trading more or less, I would say 1.3, 1.4 times price to book. So therefore, we have seen this kind of, returns where stocks have doubled, both in a combination of both, the 50% earnings upgrade as well as the valuation, coming back to the mean levels. So I think that, the story is still looking better, because if you look at the cracks, the refining cracks for diesel and gasoline and all, they are still pretty strong. And going into the election, if we don't see a major revision on the pricing side also, we can have very strong marketing margins. So considering 100% rally in all these names, some sort of consolidation or pullback is very much needed. And as we all know, that market eventually gets very heavy in terms of positioning where the momentum is. So I think there can be some sort of adjustment to that positioning. But if the cracks and the marketing margins stay healthy, I think the stocks are still looking, we are still positive in any sort of correction in these names.
Okay. All right, Ajay. Thanks very much. Good to have you on the show and good to get that perspective.